Okay, we are almost ready. No, a me non serve, facciamo tutto in inglese. Sì, la traduzione è inglese-italiano, quindi allora non serve. Almeno quello che era prima. Ok, qua c'è, there is a, no, 1, 2, 3. No, we miss Lucia. Maybe she's from remote. No problem. Okay, we are ready to go. So, I use this microphone because we have one more speech from remote, so we are good with microphones. Welcome everybody. Thank you for being here at Salone SRI. In this session, we are talking about double materiality, which is quite a very big concept for companies and investors. First of all, I'd like to stress how this topic is revealing how strong is the interconnection between companies and finance when we talk about ESG. And we started to underline this connection in Salone SRI different years ago with our ESG talks. So we are very pleased to speak about this argument. And we know that companies are now working about double materiality. They are working very hard to understand how to translate this concept in their operation, but also for investors, there is a lot to do. And we are now here to try to understand what the concept of double materiality is and how is impacting what it means for investors. So we'll do that with our guests. And first of all, I thank MCI with Megan Twin Eastman, Managing Director, ESG and Climate Research, and Colin Pavot, La Financière de l'Échiquier, Head of Responsible Investment Research, Amundi with Andrea Salvatori, Head of Emerging Markets ESG Strategies, and Lucia Meloni Candriam, Lead ESG Analyst, Government and Investment Research. You can see in the monitor. Welcome, everybody. Welcome, Lucia, that you are more far away. So I leave the floor to Megan because with her we are gonna try to understand, to have an overview of what double materiality is. So I leave you the floor.
Thank you very much, Elena. It's wonderful to be here. Hello, everyone. So I think we find ourselves at a very interesting moment in the history of ESG investing here. And I personally have been on the research side of the business since its very early days. And so I've had a real front row view for how the whole space has evolved over the last, well, nearly 25 years now, if I can dare to date myself. When I started out fresh out of university in Boston in the 1990s, everybody called this SRI, socially responsible investing. Or maybe I should say everyone who had heard of it called it SRI. Most people just sort of gave me odd looks when I tried to explain what I did for a living. And back then, the whole idea was about trying to do good, or at least do better for the world through investing. And financially, the people who are doing it mostly just hoped not to underperform too much. And there were a few who thought, thank you, there were a few who thought, you know, maybe you could actually outperform with this kind of information, but they didn't have a lot of evidence for it, and especially not quantitative evidence. And it really was a very niche section of the investment world at that point. Now, the quantitative evidence has come together rather nicely over the last couple of decades. I think we've all seen the benefits of that. And somewhere around the point of the financial crisis, people began to realize that not only is it possible to incorporate ESG considerations in your investments without necessarily sacrificing performance, but in fact, it could be really useful. And so we've all seen it gone mainstream, right? But I think as more people have come through the door in one way or another, the concept of what ESG investing is, or what sustainable investing is, or SRI, has gotten rather muddled. It hasn't been a linear evolution. It's been more like a splintering. So if you think of it like an umbrella, which seems rather fitting today, there are an awful lot of semi-overlapping ideas that are now all kind of huddled around underneath it. And the vocabulary that we use has also become confusing. I see people use the same words to mean different things, and then they use different words to mean the same thing, and they don't know what each other really mean. And sometimes even they use the same words to mean the same thing, but it's in a different context, and so it has different implications. So it's all a bit of a mess. And that's certainly true in this materiality discussion. So let's see, over the course of the next 45 minutes or so, if we can bring a little more clarity to it for everyone, or at least help you all start asking the right questions. So if we start from the beginning, I think we first have to ask, what is materiality, before we start adding any adjectives? And the working definition that a lot of companies and investors use comes from the US SEC, Securities and Exchange Commission, which says that information is material if a reasonable person would find it important. Seems reasonable, but which reasonable people exactly, and important for what? And it once went without saying that this was strictly about issuers disclosing information for investors, and it was simply assumed that the investors' really only concern was going to be about maximizing the risk-adjusted returns. And what else mattered, right? But times have changed, I think we can safely say. And so for a lot of investors today, including you all, right, financial returns aren't necessarily the only objective. And investors aren't necessarily the only reasonable people with an interest. You've got workers and communities and environmental protection advocates, and lest we forget, regulators, who all have their own fairly strong ideas about what counts as information a reasonable person might want to know. So, no surprise then, the original concept is under a bit of strain, and so we see people adding adjectives and adding terms, trying to bring some clarity to it. So with that in mind, let me trouble you with a few more definitions. Companies have impacts on the outside world, right? I think we can all agree with that as they operate the product and so on. And those impacts can be bad or they can be good, but they all have stakeholder materiality. They matter to whoever or whatever feels the impact, regardless of whether it matters to the company or not. So you can think here, discrimination matters to the people discriminated against. Ocean plastic matters to the ocean. Or you get new vaccines or antibiotics, they matter to the people whose lives have been saved. But some of those impacts also have financial materiality. So this is where there are mechanisms, transmission channels, the right conditions for the effect of the impacts to come back to the company with a financial cost or a benefit. So here we've got things like discrimination lawsuits or plastic bag bans or big fat government orders for COVID shots. And of course, there are lots of things, this almost goes without saying, lots of things that can be financially material to a business that don't really have much to do with its impacts. Interest rates, inflation, geopolitical events, we're seeing all of these right now. And so the concept of double materiality encompasses all of this. The key point is it's an and/or relationship. not an and. It's if an issue has stakeholder materiality or financial materiality or both, it's under our umbrella. And then one last definition, and I'll stop, I promise. Stop about the definitions anyway. I did want to mention dynamic materiality, another term that some of you may have heard in the conversation. And I just want to mention, even though we're not going to talk about it too much today, because it does come up. And the idea of dynamic materiality is just designed to account for the fact that things change over time. And so that impact on stakeholders that's not financially material today could be tomorrow, because the transmission channels for financial materiality can change over time, and it can be gradual or it can be abrupt. So you get shifts in public sentiment, you get a new law, regulation that comes into effect, you get a pandemic that reshapes the world's priorities overnight. All of these things can change whether something is stakeholder materiality, financial materiality, or both. Okay, clear so far, I think. Clear enough, but I think where it can get tricky is that these concepts intersect with the investment world in a lot of different places and with different parties. So you've got disclosure standards and regulations for companies. So getting all that information a reasonable person might consider important out in front of investors and maybe regulators and maybe stakeholders who are interested. You've got disclosure standards and regulations for you all, for financial market participants. Transparency reports for your clients or your prospects. You know, the regulators might have their own idea of what it is that they're targeting. You've got materiality in its various forms intersecting with legislative, regulatory, political goals. So this might be focused, as it has been in the EU, on clarity and transparency and preventing greenwashing and protecting individual investors from mis-selling or deception. It might be more ambitious and aim to incentivize reallocation of capital across the whole economy to effect a transformation. Or, as we see in some other markets, it might be about enforcing the financial interests of investors above all else, and perhaps even trying to prevent the targeting of non-financial goals for political reasons. So all of these come into the discussion, and as I said, sometimes people use the same words or different words, and it can get quite muddled when the objectives, too, are sometimes at odds. Then you've got the investors themselves, the owners of capital, objectives for the use of their assets. So is it primarily financial? Is it impact double materiality? If it's double materiality, what does that mean exactly? There's a whole range of issues that could fall under that umbrella, even if it's a narrower umbrella than the full one. And the priorities of different things under there might be different for different investors. You've got the investment products and portfolios that are constructed to target objectives. Maybe those objectives are financial or double materiality, and they're working within constraints and so on. And then finally, you've got investment tools. So I've listed, 5 or 6 different things here, all of which can be participating or subject to this discussion. I say investment tools, I mean ESG ratings, models, indexes, all those things that you might use in the investment process in order to target your objectives or do your reporting. And again, each one is designed for a different purpose and won't necessarily solve all needs at once. So you might find yourself using a financial materiality ESG rating to assess risks in a portfolio, and then adding impact data to understand your PAI exposure while you're pursuing different objectives and different portfolios for different clients. And then simultaneously, you're having to report on double materiality portfolio characteristics in one jurisdiction, while on the other hand, trying to reassure regulators in another jurisdiction that you're only looking at ESG where it has pecuniary importance and certainly none of this other stuff. So there's a lot to understand, and I think our panelists are going to help us sift through a little of this. Right? Now, this is probably a good point to address. I think there's a perception or an assumption in some quarters here in Europe, and I should say I am based in London, accent notwithstanding. The double materiality is the next natural phase for all things ESG, that things are just going to inevitably move in this direction everywhere, that it is in fact a paradigm shift in investing. And that may well turn out to be true here, but I think we need to be careful about assuming that that pattern will follow elsewhere. And this is especially important for any institution that's working with non-European clients, and especially American clients these days. So I personally find it more helpful to think of double materiality as an expansion of the investment paradigm, not a linear shift, but a growing of the space under the umbrella. It's a useful way to describe regulators' goals, some investors' goals. It's a useful way to understand what's meant to be encompassed in a set of data or a set of reporting requirements. So, at MSCI, I'm sure you all know this, we work with investors and regulators around the world. We talk to a lot of people in a lot of different places, and the conversation around financial or double materiality, financial materiality versus double materiality can be very different in the different markets. In Asia, most of our clients are focused on financial materiality, period, end of story. It's really about seeking alpha. And in the US, well, it's complicated. It feels like it's getting more complicated by the minute lately. You've got politicians and the political commentariat, especially on the right wing, have discovered that ESG and climate investing is a thing, and they don't like the direction that it's pointing, and so now they're fighting over it with lawsuits and legislation. And we have clients in the United States or who serve American end clients who are finding that managing even the ESG or climate risks that we're all pretty certain are financially material is suddenly suspected of being some kind of woke left-wing conspiracy. And so I'm not joking. It sounds funny, but it's true. And so they're having to really dance around this very carefully because that's so fundamentally different to the conversations that we're having over here. So let me wrap up quickly and we'll get on to the details and the experience in the trenches from our panelists. But let me just say a few things that I hope will be useful if you're thinking about, what does this mean for me as an investor? Help, what do I do? I'm sure our panelists will have some very practical suggestions from their experience, but I also want to offer a few principles of guidance to keep in mind that I hope might be helpful. And I hopefully won't be too repetitive as I go through because they hit back on the same kinds of themes again and again. So really, first, be clear on any differences between your reporting needs, your mandates, and your investment objectives. So from your clients and your own objectives, because those might not be all the same thing. You might be targeting one thing in your portfolio, but having to report on a wider range, for example. Second, make sure you absolutely understand the context that you're working in and who you're working with, because you just can't assume that all clients or regulators want or even allow the same thing. And an idea that seems sort of obvious and uncontroversial in one context may not be so elsewhere. And things that seem crazy to you might be real things somewhere else. I was here in Milan maybe 6 weeks ago for another event, and somebody mentioned the new anti-ESG MAGA ETF that's been launched in the US, and the room just sort of erupted like, this is crazy talk, but unfortunately it's real. Third, you want to make sure you have clarity on your objectives or your clients or your prospective clients' objectives. And if that objective is double materiality, I said this earlier, what does that mean specifically? What issues? And if you're designing investment products, ask that same question about who you're aiming them at without trying to aim everything at everybody. Within those objectives, make sure you're clear about the priorities, because you need to know there may be some hard lines you can't cross. You may have trade-offs that you need to make or that you're unwilling to make. And if you've got two things that seem to be in tension, you need to be clear about which one comes first. And with something like targeting double materiality, that's a reality. Depending on what it is that you're precisely trying to do, there may be trade-offs that you have to make. Finally, make sure you understand the intended purpose, the investment tools that you use. Now, this is a very MSCI perspective, of course. We sell investment tools, and we have a lot of conversations with clients, but also with outsiders, with the media, with regulators who are trying to understand, well, somebody's using an ESG rating for this. Does that make sense? Is that going to solve this problem that we're solving for? Well, what about controversies? What about implied temperature rise? Lots of different things. Make sure that the one that you're using actually solves for what you're trying to solve for, because we do see some confusion there. And then just lastly, generally, I've used the words clarity and transparency and objectives a lot. Really try to be transparent with yourselves, your own organization, and your clients and your regulators, because these objectives we're talking about can be they can be well aligned, but sometimes they can be in tension, or at least they can bring the necessity of considering trade-offs. And no product or portfolio can be all things to all people, at least not very well. So you need to be very clear about what you're doing for yourself, but also for whoever you're selling it to or whoever you're doing it for, how you're doing it and what the aim is. And I'll stop there, hand it back to Elena, and we'll hear from the panelists.
Thank you, Megan, for suggesting the first answer to our big question, whether double materiality is a paradigm shift or paradigm expansion. Materiality wasn't an easy concept before, though I think some companies sometimes misunderstood what materiality is. We saw some corporate documents where this exercise was very simple and not very focused about this new concept of impact, and that every company now has to deal with it, and then we will see what will happen. And the discussion on double materiality is worldwide. You talk about the USA with their focus financial materiality. We know what is going on in Europe with CSRD and our focus on double materiality. I would like to understand a little more what's going on emerging markets with this discussion of double materiality, to have also the view on that part of the world, of the market. Andrea.
Yes, hello everyone, and thanks for having me. First, a couple of words on my role. So I'm a portfolio manager specialized in equity. So that will be the biases of my thoughts here. One word I'd like to latch on and continue that I wasn't expecting is a word that Megan just said, dynamic materiality. And I think that's really a word that you'll be hearing a lot more of, because if you just think about investments for your clients, and again, I echo some of your words, you need to think about the long-term nature of many of these investments. And in the world of ESG, in the world of carbon emissions, growth, if you just look out and project over the next, say, 5-10 years, things are going to look so much different. And this is not my prognostication, not a wild guess. This is a certainty. So I scribbled down some facts, but before I go on and I give you the classic, trillions here, trillions there, I think we need to recognize that we are at a very important juncture in terms of markets. We're in 2022, and it's been an especially difficult year for all asset classes, and the fact that it's been synced, this difficulty, has made for very lackluster or just abysmal, I should say, performances pretty much across the board. And this is, in some ways, unprecedented. So usually you'll have, if you look back, historical performance numbers on any year, you'll have one asset class that really tanks, but the others carry the weight. And so you have a balanced portfolio that does okay-ish, or maybe slightly bad, but this year has been unprecedented. So there's a confluence of factors, and there's as I said, a critical juncture where ESG is also in some ways at the center of the storm. So Megan has referenced somewhat, in a very light way, the politicization of ESG. And one of the reasons why I think we are where we are is that for years we have, and my industry, in our own pitches, we've been somewhat culpable here. We've sold the story that not only ESG did not underperform, but ESG as a factor, as a style, outperformed. So once you start pushing that narrative, the moment that that narrative doesn't work anymore, you have a big issue, you have a problem. And this is what we're facing right now. We are at a critical juncture also because of a narrative that we've pushed very hard. And for many years, this narrative was actually backed by facts, by the numbers themselves. And I think it's because we've gone through some sort of a spread compression, some sort of a reduction in the risk premium, or in fixed income world, in the spreads. And it was, in terms of, and here I go back to the concept of materiality. If you think about 5-7 years ago, ESG was immaterial. It was not a factor. It wasn't really priced in. It was obviously a factor in the everyday activities of companies, especially governance, but it wasn't so much priced in by market participants. So, portfolio managers like myself would, just look at the financials, the cash flow statement, and we'd have our own methodology, but ESG wasn't. So we've gone through a phenomenal wave of spread compression, risk premia differentiation, and materiality was finally financial materiality as well. Now that finished. And once it finishes, you can't milk it any longer. So the alpha extraction opportunity from just looking at best-in-class companies in terms of ESG rating is somewhat over. Now we enter a new phase. And so going back to this idea that I think is very powerful, you need to look forward, you need to look ahead. And if you do look ahead, and this is a very, very self-serving argument, you're going to have to look at emerging markets, because that is where the core of the issues, the marginal, but also the absolute, in absolute sense, the emissions are. So China is already the number one issue in the world. Next up is India. You have Africa that has north of 500 million people that need to be electrified. How are we going to do all of this? And this is all going to happen, inevitably, in an environment where developed markets have already broken the relationship between GDP growth and emissions. So what I'm saying is that for materiality, and for the materiality of ESG in and of itself, for the very definition of sustainable investments, we're going to have to tilt the focus towards emerging markets. So your clients, their money will shape the events in emerging markets, and the events in emerging markets will shape the outlook for global emissions. And there is no different argument. There is no other side to this. So now is the unfortunate bit where I throw out some numbers. Climate finance in 2021 was there about $900 billion, a bit less, which in some ways it's actually stunning, because it was a 30% increase from the average of 2019, 2020. It basically doubled. This number is double what was a decade earlier, which if you actually track, and I'm quoting, if you're interested, the very latest climate policy initiative data points on climate finance. It was a CAGR, compound average growth rate of around 7%, which in and of itself doesn't sound that much. Well, it certainly shouldn't sound like a lofty or a high figure if you compare it to what it should be if we have a chance of meeting the deadlines that we've imposed on ourselves. We actually need to triple or in some estimates, make it 5 or 6 times what we have seen in the last couple of years. And it's going to be a challenge, and it's going to be very difficult. But if you think about the materiality in both of its meanings, so if you think about how sustainable factors impact on the financial value of a company, of a stock or a bond, on the one side, and this is sort of from the outward looking in, but also on the opposite side, how do these companies affect the environment and society? In EM, you have such, incredibly powerful dynamics in place already that the comparison is very, very stark. Very few talk about the comparison because the numbers are astronomically different. So if you think about what we focus in Italy, in France, in Germany, in terms of ESG matters, and then you compare and contrast the sheer size of the issues dynamically in emerging market, it's literally incomparable. And this is not to, I'm not saying this to belittle what we need to be doing here, because in a way there's a symbiosis that is possible and I would say necessary between developed markets and emerging markets. So excess savings from DM should rotate and go into emerging markets. So out of the crisis, it's a crisis of returns. It's a synchronized crisis, which has seen, flows also dramatically reduce over, across asset classes. But this is actually, if you think about it, a huge opportunity. It's an unfortunate opportunity, obviously. It's a bit like, the war that descended upon us, I think it was Churchill that said a crisis is too good an opportunity to waste. I think it was. I usually mango quotes, but this is a crisis that we need to make use of. And I'm going back to my equity background, and there's a saying that an old boss of mine told me that really stuck in my brain, that the cure for high prices is high prices. And I think this is also the way to read the current juncture. So the cure for the high yields, for the lack of enthusiasm, for the lack of flows, for this pivotal moment where we're facing years of gigantic necessities in terms of climate finance, is all in some ways, in a perverse way, potentially enhance the possibilities that we're actually going to make it and actually find the resources to fund this transition, these decarbonization challenges, because of the fact that the yields on offer, the valuations that we have out there are attractive enough that you can create a very cogent and very sensible case to invest in these markets, especially when you talk to clients that look out 5-10 years, and all of these opportunities for investment are yielding not just a decent financial return, but a massive dual materiality return in terms of the environment, the social targets that we have. It is not just an impellence and an urgency because of the dire needs. It's also, you can actually finally make the argument that investing in an ESG conscious way will yield very good returns. And with these words, I'll pass it on. I think I talked too much as well. So.
Thank you, Andrea. Double materiality is also a demanding concept due to the different interconnection we heard with regulation and standards. We heard the word dynamic materiality. So we have materiality, double materiality, dynamic materiality, which is the word, the expression used to link the European view more focused on a broader range of stakeholders, and the USA view, which is more focused on financial materiality. With Colleen, I would like to understand better links between double materiality and regulation. We talk about CSRD, and so we have standard EFRAG and ISSB.
Yeah, thank you. As Andrea and Megan introduced, we can see that around the topic of materiality, there is very different, let's say it's very different, taken into account very differently in the different parts of the world. And this opposition that we can see through the US and emerging market and Europe on double materiality, we also find it in the regulation. For instance, on the European side, for investors, we have SFDR, which clearly push for double materiality. On the side of the company, we have CSRD and the standard of the EFRAG, which are also really pushy on double materiality. And on the other side, which is more, let's say, US-oriented mindset, there is, unfortunately, many people which are against this concept of double materiality. On the side of investors, you have many let's say, wind against double materiality. You have some states in the US which are against the integration of ESG criteria within the investment, especially in some states like Texas. And on the company side, you have new reporting standards which are on the way, with one of the International Sustainability Standard Board called ISSB, which also declare that they will not integrate double materiality within the standard. This is really problematic to have this opposition, because ISSB is a really strong organization, which is the extra-financial part of IFRS organization. And if they decide to exclude this concept of double materiality for extra-financial accounting standard, it establishes the fact that the companies are not responsible of the impact on the environment, on the social aspect, and on the society as a whole. But who is responsible if companies are not responsible of the impact? It's not investors. Who is responsible of all the damage that we're doing to the environment? On my point of view, I think it's quite clear that human activities are responsible of the impact on the environment and on the society, and it's really important for companies and investors to take it into account in the way they develop the business, on the way they invest when we are an investors. And this challenge and this fight, let's say, between the two regulations, and the one we want to integrate double materiality and the one we don't want, is something which is really, let's say, active at the moment. And to develop a bit around these topics, I will use a citation of one scientist, which called Valérie Masson-Delmotte, which is a French scientist which is working on the IPCC, which says that the mental burden of fighting climate change must not be placed solely on the shoulder of scientists and young generation. It must concern all the actors of the society and must increase in proportion of our responsibility. And in respect to this quote, I think responsibility of company and investor is quite high. But thanks to the double materiality approach, I think this approach will allow us to highlight the hidden cost of company, which is hidden today because it is not, let's say, illustrated in the reporting of the company and the accounting system, and to value the truly virtuous model of company, and not to, in the financial point of view, and not to those which are virtuous because the cost of the damage they made to the environment is today compensated by the states, for instance. And however, even if we are all agree that company must pay for damage they cause to the environment, concretely how it works in the accounting system. And it's what we are trying to do with the EFRAG works, because what does it mean if a company decides to pollute a river? What is the cost of this pollution on the biodiversity, on maybe health of population, on climate and environmental related topics. It's really hard to measure, and it's really hard to put a price on the value on the environment. And this is a big challenge that EFRAG is trying to solve at that time. And we really hope that they will, let's say, win this battle with other regulators to make this double materiality model of reporting and accounting, extra financial accounting of company, the dominant model, because on our point of view, as a responsible investor, we really need to integrate this double materiality concept in the way we invest, because without that, it will be hard to tackle climate change and to solve all the social and environmental issues that we have to solve.
Thank you, Colleen. So we are hearing several times to this word of impact, which looks quite a simple word, but now it's very hard to define. Companies are trying to understand what it means, impact for them, how to measure the scope, and there are a lot of different things to look at and to question about, as you have to translate this concept into reporting, because they are trying to set the stage and the reporting documents to be compliant with the new CSRD. So I would like to understand a little bit more about this with Candram, Lucia Meloni, which is in connection with us. Lucia, hi, welcome
Hello.
back with us. Let us understand a little bit more about CSRD, how it started, and also this concept of impact involved in the new reporting directive.
Yes, hi. Thank you so much for having me today. In remote, but I'm here. So yes, regarding the concept of double materiality and CSRD, CSRD is the European Directive on Sustainable Reporting that has been adopted just last week by the European Parliament on November 10th. So it's a really fresh news. And this directive is aiming to update and also to amend the current non-financial reporting requirements set for companies under the Non-Financial Reporting Directive in 2014. So we had this NFDR, which is really the current directive, which was set in 2014, but we need to amend it, and it's thanks to CSRD that we managed to amend in order to have more impact and in order to have a clear view of what is double materiality. So in order to have a little bit more of background, because it's important to understand what the NFRD, which was adopted in 2014, what are the strengths and the weaknesses, because the NFRD introduced the very first reporting rule and really established the really important principles for certain large companies to disclose sustainable information. So this is really important, and one of the most important principles introduced was the concept of double materiality. The scope of application of NFRD applies to large public interest entities and it doesn't excess 500 employees. So the scope was very limited, roughly around 10,000 companies are subject to NFRD reporting requirements. So here the concept of double materiality was introduced. Like the speaker said before, it's really on a double aspect on how sustainability issues affect their performance and how their businesses impact people and the environment. But there is not enough definition of what stays in those pillars. So the European Union, after several years, because it was adopted in 2014 and we are in 2022, said, and I quote, that there is an ample evidence that the information reported by company is not sufficient. because there was a lack of standardization of data, and also because the primary user of sustainable information, such as investors, such as in Canvem also, we require more information than companies are currently required to report. So there is a little bit of mismatch between what it is disclosed and what we need and we want to be disclosed. And also, one of the weaknesses is that there are too few companies required to report. So the aim of CSRD is to widen the scope. So we will be to 1,000 companies to 50,000 companies. So the scope of the reporting is going to be much larger. And also one thing that is really important is that the information is not really, and it's not easy to compare between companies. So this was one of the issues that we wanted, the CSRD want to highlight and to really put more clarity, as Megan said before, transparency and what we need to disclose. So it's really, the aim is really to widen the scope, to increase the amount of information that companies will report. And also one of the important points is to set an auditing requirement for assurance of information. So I think we are going on the right direction with this directive, and is expected the Council to adopt end of November. So this rule will be applying starting 2024. And CSRD, coming back to the concept of double materiality, it's really important because it's giving clarification on the materiality principles. It gives really guidelines on what information is really needed on how systemic aspect affects them. So it's outside in perspective, like we call it. So from the outside to the inside. So it might be the regulation, as I said before. So we have also the energy prices that has an impact on the company. And what is the information that is necessary to understand how they affect people and their environment, inside out perspective. So how the company is having an impact on the world, saying working condition, also governance or bribery. So these are the two concepts, and I think that we're heading towards a good direction with this directive.
Thank you, Lucia. Well, now that is clear how much complicated is double materiality, I would like to understand a little bit more how it is integrated from investors into analysis and portfolio management. So I will stay with you, Lucia, and ask you how can we consider this concept in your ESG analysis?
Yeah, when we perform an ESG analysis, so we really take into account this concept because we have two main pillars when we analyze an issuer. So the first main pillar is the business activities analysis. So we are analyzing how a company is really assessing towards main trends, main key sustainability challenges that we have named, such as climate change or health and wellness. So we assess how the company has an impact on these key sustainable challenges. So for example, a coal mining company, what is the impact that it has on climate change? So we're going to see that coal, it has a really negative impact on climate change. So it's going to be a negative impact. So we're doing this broadly on each sector. So we are assessing really the impact that the company has on these global trends. So in order to see if it has positive impact or negative impact. And this, it's really on the first pillar of double materiality. But then when we analyze an issuer, we also see what are all the stakeholders, because we also, Megan also mentioned stakeholders. It's really important to see what is the environmental regulation, for instance, because we're going to assess the environment strategy of an issuer. So the coal mining issuer can have a business model really that has a negative impact on climate change, but on the strategy, so how they want to have an impact, the company on the outside world, what are the environmental strategy put in place? So we're talking also about net zero strategies. What are the targets that they want to highlight? So the interim targets. So we can have this kind of view on the climate change, so double materiality on what is the impact on the outside world, but also what is the impact of the regulation coming from and has an impact on the company side. But we can have this discussion also on the social side and the governance side. So we really try to assess how a company position itself towards these key sustainable challenges, but also in front of the regulation. So both thematics are taken into account.
Thank you. I will pass the same question to Andrea, if you have if you can help us to understand how you integrate in day-by-day business this concept.
Yes. Whatever Lucia said, in the case of emerging markets, is more difficult. And we're having to contend with lack of data. In some cases, it's very lagged. The companies have very differing stances towards sustainability matters. So you will find a Brazilian company that's very eager to catch up. And if I were to very, ballpark say how behind we are in emerging markets, I would say 5 years. So an EM company is where 5 years ago would have been the equivalent DM company. But there's very differing views about the challenge. Some of them are genuinely, frantically improving and trying to catch up, and some are not. There is a little bit of a country bias in this statement. And I won't go into the details of this and get in trouble in terms of what countries I find, persistently lagging and without a real willingness in many cases to actually catch up. But there is this. But if you go back to the theme of and the very definition of double materiality, these sustainable factors, how do they impact the financial value of the firm? And again, I go back to this idea that in emerging markets, it's whatever was said times 5 cubed, much, much more important, because in some cases, it is whether a company has a viable cash flow dynamic or not. Can they meet the regulations that are imposed? Do they have the wherewithal? Do they have the CapEx capacity to cope with emission regulations, with labor safety standards? In some cases, the answer is actually no. But on the second side of the definition of double materiality, it's even more in overdrive, the relevance of EM, in that how do these companies affect the environment and society? Well, it's huge. I was chatting before this panel with a couple of colleagues, and they were surprised and baffled because I pulled out a stat on a South African utility, the largest utility over there, and the sheer amount of CO2 emitted by that single company in South Africa, because it's largely sourcing the electricity generation from coal, is almost the same as the whole of the European listed utilities combined. So you can understand, the second side of materiality. How does the company affect the environment? Well, in a huge way. And, thinking forward, how do they address the requirements, the needs, the challenges? There are various routes that these companies can take. What this company can do, and the cheapest solution is to, have brownfield or even greenfield expansion of their coal mines. They could do that. And the impact on the global environment would be astronomical. So this is where climate finance comes in and actually makes a difference, because the sheer size of the problem at hand is massive, massive. So I want to leave you because, Megan was talking about the late 90s. I'm a lot older than she is, as you can tell. And I was involved in sustainable finance in '99. I was begging my CEO at the time to launch a fund. And back then it was called Ethical. We were running an ethical fund. It was even before SRI. And a decade before that, there was the so-called Brundtland report that actually defined what sustainable means. And I read it because I'm going to mangle it. Sustainable development is development that meets the needs of the present without compromising the ability of future generations to meet their own needs. So you see how there's this dichotomy between present and future. My take is that if we were to adjust this definition in 2022, we should replace present with developed markets and future with emerging markets.
Thank you, Andrea. And I would like to add a further concept to our discussion, which is fiduciary duty. Because for a lot of time, fiduciary duty has been a sort of big elephant in the room of ESG, and ending up saying that for those supporting ESG, there was no trade-off between the two concepts. So now, how we link fiduciary duty and double materiality?
Yeah, thank you. The dynamic of the appropriation by asset manager of this concept of double materiality is deeply linked to the definition of fiduciary duty and your definition as a client of what you want to say by fiduciary duty. Today, there is unfortunately still two definitions of fiduciary duty. There is, let's say, the old vision of fiduciary duty, which is only focused on financial materiality. We see ESG only as a tool to manage the risk of your portfolio, and the investor which follows this definition of fiduciary duty are only focused on the financial performance and on the profit maximization. Maybe I'm young, but I consider that it's a bit old-fashioned definition of fiduciary duty. There is a more modern vision of fiduciary duty, which is much more focused on double materiality, which is the definition which was introduced in 2005 by the Freshfield report, which was a report driven by the United Nations. And this report clearly pushed the concept of double materiality within the definition of fiduciary duty. What does it mean concretely? It means that this report says that the fiduciary duty is, on the side, making performance for our clients, but not at all price. Let's say you have also to manage the impact of your investment on the environment and the society as a whole. Then, as an asset management, if your client don't want to have this modern vision of fiduciary duty, it's hard to integrate it in the way you manage your fund. At LFD, we're lucky because we have clients who have this modern vision of fiduciary duty, and this helps us to develop our ESG rating methodology, to integrate more and more this concept of double materiality in the way we analyze the company, and also in the way we develop new type of products, and especially they push us to develop impact investing. And impact investing, let's say, it's the best way to integrate double materiality in the way you invest. Concretely, impact investing in investment which is made with a specific intent of generating a measurable impact. We can be social or environmental or both. It can be linked to what is expected with SFDR regulation behind the Article 9, but it goes also further because it's something which is much more precise and which answers to 3 pillars, which are intentionality, additionality, and measurability. First one, which is key when we talk about double materiality, is intentionality. Intentionality, what does it mean? What is the intention of the fund manager when he decides to invest in a company? If you have your, let's say, double materiality glasses, your objective will be to invest in a company which will manage properly its risk, but also which will have a positive impact. Then in an impact fund, you need to select company according to what we call an impact thesis. If your impact thesis is to protect biodiversity, you will choose the company which will go in that direction, maybe developing solutions to protect biodiversity or reducing the impact of biodiversity. Then this is intentionality, and to make it possible, you need to have strong methodology, which integrates this notion of double materiality, but you also need to have governance around the management of that fund, which make you sure that every time each investment decision will take into account this concept of double materiality and impact. But I say there is 3 pillars, and there is a second one which is called additionality. Additionality is how, as an investor, we can use our power of investors, let's say, to help the company to improve its positive impact on the society and reduce its negative externality. It is possible through engagement. We're doing a lot of engagement with the company to advise them and to help them to improve their impact, but also by being a patient investor, staying shareholder of a company for a while, giving them the stability they need to develop their sustainable development policy. And the third pillar is measurability, because it's really good to say that you will have an impact and you want to have an impact on this and this topic, but if you say that, you have to prove it, and you have to prove it with your client with impact measurement, which ideally is done in partnership with an external auditor, and it's what we are trying to do with impact investing, is to measure our impact and to show if we succeed in integrate properly double materiality in the way we invest. And if the client gives us, let's say, the mandate to follow these double materiality guidelines with their own definition of fiduciary duty, then we can do many interesting things. We can maximize the impact of the investment, but all of you have to be aware that, yeah, when you give the mandate to an asset manager or any investor to invest your savings, you need to be clear on that mandate to be sure that your savings will have the impact you expect.
Thank you. So we are at the end of this interesting roundtable. Megan, tell me if I'm wrong, but I think that double materiality is a concept and an operative challenge that will stay a lot with us in the near future, and then will bring companies and investors to dialogue and engage maybe a lot more of what they did until now.
I certainly see a lot of ongoing discussions in our future, yes.
So I thank you all our panelists, Megan Twin-Eastman, MCI, Colin Pavot, la finanziaria dell'Echiquier, Andrea Salvatori di Amundi, Lucia Meloni di Candriam in remoto. Ringrazio anche voi. Vi ricordo che c'è il coffee break subito adesso nel corridoio vicino alla sala Bramante, e vi aspettiamo in sala Leonardo per le ultime 2 sessioni della giornata. Grazie.